Hello everyone and welcome to MasterExcelNow. And today we are going to see how do we calculate different types of interest and future value of an investment. So let's begin with simple interest. So if you have invested 10,000 for 5 years at an interest rate of 8%, what is the total interest earned at the end of the term? So the formula is principal, which is your 10,000, multiplied by rate, which is 8%, multiplied by the term, which is 5 years, and the total interest earned at the end of 5 years is 4,000. So next up is compound interest. Compound refers to when you get interest over your interest. So let's say you've invested $100 in an investment for 5 years at an interest rate of 10%. So at the end of 1 year, the interest is added to your account, which is 10 at the investment of 100, right? So now your investment is $110. For the year two, when it ends, you get an interest of $11. And the principal which will open for the third year will be $121. So this is called compound interest, where you earn interest over interest. Let's see how we can do this math in Excel. So here we have the principal is 10,000, interest rate at 8%, and tenure is 5. So what we are going to do is equals to, first is our principal. So we have that principal, which is cell B2. Then we have to multiply it by 1 plus rate. Rate is 8%, brackets close, to the power. The symbol for power is a caret symbol. It's available on the number 6 on your uh, keyboard. And then we say tenure. Tenure is 5 years. Now, this is the compound interest plus principal. So I only want the compound interest. Hence, I'm going to subtract my principal. So here I'm going to subtract my principal again. And here is the total interest earned in 5 years, which is a compound interest. Remember, we did the same calculation for simple interest and the total amount was 4,000. So you see the difference and the power of compounding here. Next we have is future value. Future value refers to what will be the total value, which is principal plus interest after a period of time. So if you have invested 10,000 in a investment bond or a portfolio and you expect a return of 8%, the term is 5 years. So what is the total value that will be there at the end of the term? So first, there are two methods to calculate this. The first one is using the compound interest and the principal. So if you just see, I subtracted the principal in while calculating compound interest at the end of my term. However, in this case, we will simply use the formula for compound interest. That's your method one. Let's try that first. So we say equals to principal multiplied by bracket open 1 plus R. R is rate, which is 8%, bracket close, to the power time. Power symbol is by the caret. We use a caret symbol here for power, and then we say tenure. The tenure is 5 years, and then we hit enter. So this is the future value of 10,000 at 8% for 5 years. This is the first method of doing it. I'm going to copy this real quickly and let me bring it here. Perfect. So we're going to compare this both methods again. The second here is we can use the formula for future value directly with equals to FV, bracket open. So here if you see it says rate and per payment and the other two is optional. So we're going to use these three. First is rate. So my rate is 8%, comma. The tenure is 5, comma. Then payment. There are no payment. The amount is invested upfront. Hence, it's a 0, okay, comma. And in this case also, I'm going to subtract the principal at the beginning. So why I'm going to do that, I'll just show you. So once I do that, what will it show is that I have invested 10,000 today. So it's a minus, but when it calculates the future value, it will add 10,000 there. So let's see. So the future value is 14,693. However, let me give you the example that I was sharing right now. If I don't do a minus B2, so I just say B2, so see, it gives me a negative value because then it does not factor in the investment, which is a ledger, credit and debit concept. So here we say minus B2. So next we have is when we have to calculate simple interest on an investment which is going to be monthly. So here we have a situation where we have invested 10,000 at the beginning of the investment term, and then we have a investment term of 5 years where we are going to invest 10,000 every month, which is 60 payments. 5 into 12, 60 at an interest rate of 8%. So what we need to do is first calculate our principal. Then we are going to use the formula of simple interest. So how do we calculate our principal is the first payment, which is 10,000 plus 10,000 into 60, 60 payments, which is for 5 years monthly. And then we are going to use the formula of simple interest. How do we do that is equals to brackets open 10,000, which is B2 plus brackets open 10,000 into 60. So total investment is 61 months. The first payment that we did and 60 months consecutively thereafter. Once we've done that, we close the bracket, multiply it by interest and the term. Term is 5 years. Because we've already entered 60 here, so term will be in years, 5 years, and close the bracket here and then hit enter. So the total simple interest that we've calculated is 244,000. Now, let's say what is the total principal that I've invested. I will like to show you that. So we say principal invested. So once we do that, let me show you real quickly. So a simple math is you can say equals to 10,000 into 61 payments that you've done. This is your total principal invested, and you have earned 244,000 on this investment in 5 years at 8%. Now let's see if we were investing on a monthly basis, how do we calculate compound interest to future value? The formula here will be the same. The only thing is, if you subtract the total investment amount, it will be counted as compound interest. And if you add the total investment amount plus add the interest to it, it will be a future value. So first thing we will do is identify the rate per month. So in our case, it's 8% annually. However, we have to calculate it on a per month basis. So it will be equals to 8 divided by 12. So every month it's 0.66%. So that is the number that you are going to use, and that is calculated here in the formula. Then we tell it total months because the period that we are calculating is in months and it is 60. 5 into 12 is 60. So that's month. Then the initial investment. So we invested 10,000 as the first payment. And then every month we are going to invest 10,000. So total payments done is 61. And the payments are done on the first of the term. So first of the month. So if we were to now put this formula into action, is going to be equals to FV for future value bracket open. Then first is the interest rate. So our interest rate is 8% divided by 12, comma. Then total months, it's 60, comma. Then initial investment. So we will subtract initial investment when we are calculating this, comma, minus the monthly payment as well, because this is considered as an investment. And then the first of the month, the payment is done. Now, when we hit enter, we get the total amount here. So this is the future value, right? Now, again, we are going to calculate the principal invested. So when we calculate principal invested, what we are going to do is equals to 10,000 and into 61 payments that were done for 10,000. Hence, your compound interest, this is interest amount minus principal. Sorry, yeah. So your compound interest is equals to this value minus this. So 144,565 is your total interest, compound interest. The investment is 610,000, and the total value at the end of the term is 754,565. So this is how we calculate simple interest, compound interest, and future values in certain cases. If you enjoyed the video, please do leave me a comment. Let me know what you liked about the video and how we can improve it. At the same time, I request you to please like, share, and subscribe the channel. It really helps us to get to more audience and get a more constructive feedback. Thank you. Have a nice day.